I'm Priscilla Barrera with the Investing News Network, and here with me today is Chris Berry, who's president of House Mountain Partners. Chris, thank you so much for joining me today.
Thank you for having me. It's great to be back in person.
Yes, 100%. And you've been at conferences this past week. I wanted to start by asking you, how are you finding overall sentiment in the industry towards the lithium sector? And also maybe if you could share some major highlights for you from these events.
Yeah, I would think, first of all, I think everyone is just happy to be back out, in the flesh, so to speak, in front of everybody. It's nice to make actual acquaintances with people that I met over the last couple of years on Zoom, and I know I'm not alone in that respect. I think that, the mood is overall very bullish across the supply chain, from miners to refiners all the way down. There is a concern, I would say, with the macroeconomic picture with respect to inflation here in the West specifically, and of course that's rooted in a number of issues: the Ukraine war, of course I think the backlash from COVID, and a lot of the same things that we've seen over the last couple of years. But nevertheless, very bullish sentiment, and I think you can just look at the lithium price in China and understand why. I would argue that now maybe a little bit of maybe a time for some more caution, or maybe a little bit of a pause in terms of how you approach this space. And I'm happy to elaborate on that, but never in my wildest dreams would I have thought we would see $70,000 spot lithium. So I'm very happy to see it. I think there are a number of reasons behind it, whether or not it's speculation, stockpiling, and of course just outrageous demand in China. But I don't have much of a feel for if we go to $100,000 a ton or wherever we go. I'm just a lot more focused on when this cycle gets a little bit long in the tooth, and when we mean revert, where do we land? Okay, and I'm not at all predicting that we're going to go to, say, $6,000 or $10,000 lithium anytime soon, as certain investment banks, I think, seem to be saying. But, we will kind of equilibrate, I think, between spot and contract pricing. And I think you're probably going to start seeing that in the next, 18 months. So that's kind of what I'm focused on right now.
And I wanted to touch on this macro view that you started speaking about. And, we're in an environment where there are inflation is talk of town, recession fears, rate hikes. How do you see this impacting the battery metal space?
Well, if you look at companies like Tesla or BYD, they've already announced that they're going to be raising prices on their customers. And I think that's just a direct result of everything you had just mentioned, inflation, interest rate increases, and things like that. And I would expect that to continue for the next little while, to be honest with you. That sort of beautiful chart that we all look at in this space of that decline in terms of, every year, dollars per kilowatt hour battery costs, clearly has been arrested. I would argue for this year and next, battery prices are going to rise on a dollars per kilowatt hour basis. Not enough to destroy this whole narrative and this whole theme, but certainly it's put a little bit of a shiver, or maybe a pause in some of the bullishness, despite the high prices. I actually think the battery metals space, of the supply chain, has been amazingly resilient despite all of these scary headlines that you see on CNBC and Bloomberg. And so, it's insulated to a certain degree, but as I mentioned before, if you can look at examples like Tesla or BYD, it's not immune. So I think it's maybe the first instance, if you will, of the supply chain kind of getting a little bit of religion and trying to figure out what the optimal prices are for expanding capacity.
So from an investor perspective, most of our audience are investors. So does your strategy change in periods like this one of high overall market volatility? And what are some tips maybe you can give to our audience to still weather this storm?
Yeah, I think, it all depends on your time frame, right? If you're thinking about quarter to quarter or end of the year 2023, I think you're pretty cautious. Right now, and you can even look at a number of share price returns for not just junior miners, but also some of the major miners as well. And they've been pummeled in the face of, year to date, pummeled in the face of everything that you just mentioned from a macro perspective. But if you take a step back and say, okay, well, let's think about how big this industry is going to be in 2025 or 2030, the volatility right now isn't really it just doesn't hold the same weight in terms of concern. So, and that's how I tend to look at these markets. I mean, look, it's been an incredible run for all of us in the space from kind of those post-COVID lows to say the end of 2020 to now. And you just can't have a situation, if we just talk about lithium for a second, where demand gallops along at 20% a year, and we all know about the supply challenges that this industry has faced, not just in recent years, but for its entire history. So I would expect to see, under the best of circumstances, very tight markets for a lot of the battery metals, no oversupply for the next few years at least. And so I don't see any reason why you wouldn't maintain that bullish kind of long-term view.
All right, so no oversupply for a few years at least is what you're telling me, but we are seeing that fear of oversupply hit the market again for many reasons. The lithium stocks have been hit as a result. What I wanted to ask you is, what do you make of this disconnect between sentiment and equities in lithium in particular, and do you see that trend continuing for lithium stocks? So will we get over this oversupply fear?
I don't think you ever will get over this oversupply fear. I mean, this is the third lithium cycle that I've been through in my career, and each time, the industry got out over its skis, so to speak. I can remember, I think it was 2018 when lithium carbonate hit $24,000 a ton. That was the top. There was a hard rock supply response in Australia, and everything just kind of fell in on itself. It is different now. I think governments are a lot more involved. I think ESG is, of course, a major focus, and there's still tightness along the supply chain, and those are keeping prices elevated. With respect to the disconnect, I think that, look, we all know in this game that as the commodity price takes off, the equities follow suit. And again, going back to the end of 2020, that's precisely what's happened. And since lithium has kind of hit a peak at, say, $70,000 in China, it's no surprise, in my view, to see the equities kind of take a breather. So I think what you're waiting for now, if you're looking for these producers, is, okay, let's see them expand capacity on time and on budget, and then really start generating that free cash flow, either to plow back into their business or ideally give it back to shareholders in the I guess form of dividends or share buybacks. So it's, again, this is not something that's going to happen tomorrow or next week, but I think that's how you position.
And with this better market conditions and with stock prices being low, do you expect to see more M&A activity? And which type of companies do you think are better positioned to be acquired?
Well, look, in terms of who would be acquired, I don't think there's a secret formula here, right? I mean, which of those companies that have, say, feasibility level economics that give potential acquirers an idea of what they're going to be buying. And, I would not run economics at $70,000 lithium. I would run it at the most sort of conservative. I would run it at 12. I would run it at 15. Just to see, okay, can this project that I'm thinking of acquiring or maybe joint venturing with, will it work at, whatever the prices are in the future? So, I don't think you're necessarily going to see a lot of M&A imminently. And again, that is because when you look at who could be acquirers, SQM, Albemarle, Livent, just to name a few, they're all busy expanding their own capacity. It could be different for some of these Chinese players. And, if you just go back to last year and you think about some of the largest, two of the three largest deals, I think, in the lithium business happened in Argentina. Actually, all three of them happened in Argentina, your homeland. And they were executed by Chinese players. And so, the Chinese are always sort of well known, I think, in this space for having the checkbook and being willing to write checks. So, I think that the producers, either near term or existing, are very busy expanding their own capacity. So I wouldn't think, maybe for the remainder of this year, especially with lithium pricing as strong as it is, that you'd see a great deal of M&A. But, I wouldn't rule it out longer term. Again, and it's just because you can't have a situation where demand gallops so far ahead of supply and expect the industry to keep up.
And another, I guess, big theme that we've been hearing about here is ESG. What do you think remains a challenge for this industry in terms of ESG?
Well, I think defining it, first of all, that's always been the problem. Or I shouldn't say the problem, maybe the challenge, right? Who's whose criteria are you as an investor going to use? Are you going to use the company's criteria? Are you going to use the United Nations criteria, or a third-party consultant that may have executed a life cycle assessment analysis? It's difficult to I think come down with a specific winner, and so the industry, the whole supply chain is really struggling with what does ESG mean? I think the S and the G, quite frankly, are, I don't want to say easier to solve, but they're much more straightforward. Mining is still regarded by many along the supply chain as the most capital intensive and carbon intensive portion of this whole business, and trying to reconcile keeping your costs in check while minimizing carbon emissions. It's certainly doable, but I would argue every project, whether or not it's lithium brine, lithium hard rock or clay or nickel, what have you, is going to have a different profile, going to have a different ESG profile. And so I think investors are just going to need to, quite frankly, pick a set of criteria and stick with it and be comfortable with what they get. You're never going to, in my view, this is maybe controversial, but there's never going to be a completely zero carbon supply chain or a negative carbon supply chain. Maybe in the distant future there could be, but I just think that the business right now is too capital and carbon intensive to satisfy everybody. So we're going to have to push forward with this and kind of tweak it as we go.
Obviously, if we talk about supply, we should definitely touch on supply chains. And I guess a topic that the pandemic, I think, accelerated is this build out of local or regional supply chains. What have been some major developments you've seen in this area since the pandemic hit?
Well, I think, again, the pandemic really laid bare the frailty of supply chains here in the West, whether or not it's the U.S. or the European Union, and our reliance, of course, on strategic adversaries such as China. And so, that's obviously the biggest lesson and the biggest takeaway. I would say that, in the 12 years that I've been focused on this theme, I've never seen government at the federal level, state level, what have you, so certainly on the federal level, willing to start to pour money into the supply chain. I'm talking about the critical minerals supply chain, to try and build a more regionalized structure. Even, President Biden has said that they're certainly willing to do it, whether or not it's through Build Back Better, which is kind of in a shambles right now, but something will emerge from that. But, they're also looking at partnering with allies, partnering with the Canadians, partnering with Australia to start to build pieces of these critical mineral supply chains, whether or not it's actual mining raw materials or, in the case of rare earths, for example, the Department of Defense granting Lynas, a rare earth player out of Australia, about $120 million to build a separation facility in Texas. So I think it's going to be a much more regionalized structure. I think it's going to take 10 years minimum. So I do worry about the political will to see some of this through, but I think it's going to happen.
And just today you were part of a panel discussing this geopolitics of lithium. And I just wanted to ask you about China because it was part of the discussion. And my question for you is, what can the West learn from China in terms of building its supply chain, and what do you think it can do better?
Well, I think, if there's a flaw in the Chinese model, it's that they build the capacity at all costs, and they worry about excess capacity after the fact. And we have seen that in any number of industries. I mean, I think the solar business is probably the most glaring. But even, on the lithium side, there's always excess conversion capacity in China. There has been for a long time, even as they build out more conversion capacity onshore today. I would think that, what lessons we in the West learned is to maybe walk before you run and try and sort of right-size capacity with what we actually think is going to be there at a given point in time. Here's an example. So right now, the forecasts in the United States are for, I think, 720 gigawatt hours of battery factory capacity by 2032. I mean, that is an absolutely outrageous number. And these are publicly available statements all added up, right? So I'm not making this up, but my point is that we're not going to be able to build that here in the United States, okay? It's just not going to happen in the time allotted, and you're going to run into raw material constraints. So I would just caution, participants along the supply chain to think very carefully about access to raw materials and then the ability to feed that downstream to maybe get to, 400, 500 gigawatt hours, which would still be a huge win, but I think is probably more realistic in terms of targets. And, the Chinese have never thought like that. They said, okay, we're going to own this business. So if it's building 700 gigawatt hours by a certain year, we're going to do it and we'll worry about the capacity later. I mean, we obviously, in our, financial and economic system here can't afford to do that. So it's a big lesson.
And I know that in the past we talked about how technology could play a key role in helping fill that supply gap. Is there any type of advancements in technology that have caught your attention recently or you're watching closely?
Yeah, I've been generally bullish on recycling and direct lithium extraction. We've talked about that in the past. I remain bullish. I think that there's a role for each technology here, again, in a regionalized supply chain structure. I wouldn't think that you would see a direct lithium extraction project. I think you're probably going to see one partnered with an existing brine before you see its own a standalone DLE project. I wouldn't think you would see that really start to impact the market before later this decade, to be honest, because of course DLE is unique, right? It's unique based on your source, and so I think that I'm bullish on DLE. I'm bullish on recycling because they can help to not plug a gap between supply and demand for some of these metals, but they can certainly be additive to supply. And I think, that's all you can ask for. I could see, we talked about this earlier on the panel, but I could see recycling maybe from, mid-2030s onwards being a significant, well over 50% of domestic battery materials demand. So, it's going to take us a while to get there, 13 years or so from now. But you got to be building that capacity and perfecting the technology today if you want to be owning the supply chain, by the mid next decade.
All right. And my last question for you, Chris, is actually what's going to happen from today until 2025. So not that long to the next decade. So if you could briefly define or explain to our audience that is listening today what you expect to happen until 2025.
Well, look, I think that it depends on which part of the supply chain you're referring to or thinking about as an investor. But I guess my view is that if we just talk about lithium, which is, I think, the most accessible raw material for everybody involved, I do not see any way where you could tip lithium into oversupply on a global basis. You just can't have a situation. I think, looking out to 2025, you can look at supply forecasts, what's going to be coming on stream between now and then with a pretty high degree of certainty. Whether or not it's existing players, the Albemarles, the Livents, the SQMs, or near-term players like Lithium Americas or Sigma, Lithium, or Core. And maybe you apply a little bit of a discount to some of these near-term guys because we all know that it takes a little bit longer to ramp up than is forecast. But my point is that I just don't see any let-up in demand. And so, again, as I mentioned a couple of times earlier, as demand kind of gallops forward at 20% a year, and you have potential supply chain problems or supply addition problems, I think that from a pricing perspective, you're going to see, lithium obviously on a contract and a spot basis well above $20,000 a ton. I just don't think that it would go anywhere near south of that given some of these demand dynamics that I'm mentioning.
All right, Chris, thank you so much for joining me today.
Thank you.